Good evening, everybody. Uneducated Economist here. So I thought I'd give you guys a second video today, talk a little bit more about the video I had put out earlier. And in that video, I had pretty much said that interest rates are going to rise and that I am a strong dollar believer. And I had a lot of people kind of call me crazy on that one, saying that there's no way that the Federal Reserve is going to allow interest rates to rise or allow to let the dollar strengthen. And And I have a tendency to believe a little differently than that. And there's quite a bit of reasonings behind it. Now, the number one reason that I have to think about why the Federal Reserve would not allow interest rates to go down from here is because they've already talked about the effective lower bound. And now, if you remember, they used to use the term zero lower bound, but they changed it to effective lower bound. And the reason they called it the effective lower bound is because they have essentially hit the effective lower bound, meaning that monetary policy is no longer effective. That's it. So that's something to think about as far as dropping interest rates go. They already know that monetary policy has stopped working at this level and that it's going to take other tools that the Federal Reserve can use in order to stimulate the economy. And now I got a great video coming from a Federal Reserve president of St. Louis there. Jeez, I can't remember his name offhand, but he's pretty popular. You see him in the news all the time. Now, I have a video, it's very short, where he's talking about the quantitative easings and the effects that it had on the economy. And the reasonings that they used it is because they really didn't have anything else going on. They didn't know what else to do. There was two things that they used, the quantitative easing and the forward guidance, saying that they are going to continue to keep the monetary policy low. This is what kept the inflation going inside of the economy. And it was really barely effective at all because, well, this is something else, guys. Let's not argue about whether or not we have inflation. Go to Shadow Stats. He'll tell you right now consumer prices are running out like 8%. Okay, Federal Reserve says it's running less than 2%. It doesn't matter what Shadow Stats says. We have to go off of what the Federal Reserve says because they're the ones who are handling the monetary policy. Okay, so the Federal Reserve for the last 10 years has attempted to hit this 2% target. They haven't achieved it yet, and quantitative easing has worked. I questioned that right away. And I'm like, well, it wasn't effective. In fact, if it was effective, it would have achieved that 2% inflation target that you were shooting for, and you would have been able to raise the interest rates back up to a more normal position, your ammo, so that you would have the monetary policy above the effective lower bound to a point that you could actually use it. They did get it to, I don't know, they got it almost up to 2% or something like that on the Fed funds rate before they ended up reversing course. That was they were calling it autopilot, where they were allowing the interest rates to rise a quarter percentage point every quarter for like however many months. They were going to do it until they no longer were accommodative nor restrictive to the economy, and they found out right away they were restrictive to the economy. Then after they started dropping interest rates, then the recession hit and everything went to terrible after that. So interest rates rising from here. A lot of people called me crazy on it, but yet I went and started doing some research on it. I found two articles right away giving great arguments to why the interest rates may be rising into the future. And now one of them was just talking about how just the recession coming to an end and that there's going to be like kind of like a boost to the economy as like the vaccines come out and stuff like that, and people feel more comfortable about spending their money. That flood of money coming into the economy is what's gonna kind of spur this growth. Once this growth starts kicking in, you're going to start getting the money velocity going. And again, then you're going to start seeing the inflation start to kick up. As the inflation starts to rise and the investors start to demand more from the U.S. treasuries out there, you're going to start seeing the actual results of inflation, or at least on the Fed's accounts of it. And then the interest rates will begin to rise. Now, here's something that's really crazy about that is that flood of currency or that flood of money that can come in, it doesn't have to just come from the stimulus packages. The Federal Reserve already knows that there's a bunch of savings out there, much more savings than pretty much in years. I can't remember what the stats said, how far back it goes, but there is a lot of savings compared to recent times. And that flood of savings can come into the economy at any time. And if you have the vaccines plus this flood of savings that is coming in all at the same time, it really sets you up for an opportunity to have that money velocity getting you into an area where you have a lot of inflation. The Federal Reserve has now got this 3 or 2% average inflation over the course of some time. Now, they don't necessarily exactly explain what that sometime is, but I can only assume that it's probably going to be something like a 3-year or a 5-year, but they're probably going to come up with some formula for it. What I kind of wonder is if it's 2% and we're almost to the 2%, like, we were at like 1.5%, like some of the time. If inflation, say, ran like really hot, like say all of a sudden there was like the stimulus package that we get coming in at the same time the vaccines, at the same time people start spending their savings, and all this business and all this money and all this stuff starts floating through the economy, and we just really get things rocking and rolling. Everybody's really happy and the markets are flying off the charts and the interest rates start to rise because everybody sees the money inflation happening, the price inflation taking place. At the same time all this goes on, this is where it can get really confusing, but the corporate debt, right? The high, not the high risk, but the high quality corporate debt out there. If the interest rates on the 10-year Treasury begin to exceed that corporate debt, all those corporate debt bonds really become like the hot potato, and nobody's going to want to touch them. Because the interest rates that you can get on a Treasury, the super safe, 100% guaranteed going to pay, is higher than a risky corporation, where the chances of default are much higher than the United States government. And you can see what happened to all the corporations out there, especially the zombie ones, when this starts to take place, when they all of a sudden are not able to borrow money at the cheap, low interest rates that they are right now. The only thing that would save them is that they would be right in the middle of a hot economy. And I think that's what the Federal Reserve is trying to shoot for. They cannot lower the interest rates, guys. It's not going to happen. They would destroy themselves. They're a private banking organization that does not want to die. And if they went into negative interest rates, they would pretty much be writing their own death sentence. Other nations have done it. It doesn't mean it works. It doesn't mean it's going to last. And yes, they can go into negative interest rates. Okay, there is nothing out there that says they can't. But I have a very serious doubt in my mind that they will. Governments make stupid decisions all the time, but a private banking organization who wants to profit and succeed and carry on probably would not be making decisions that are going to self-destruct. So those are some of the things I thought about. I'm going to leave links down in the description for 2 articles and a video. The video is for the Federal Reserve President talking about the quantitative easing and how the effects of it on the economy were, awesome, but really it was ultimately just the jawboning that really did it. It's the idea of getting that out there, that there's going to be inflation, that convinces people there's going to be inflation, that gets people out there to start spending their money. That's the whole idea. The inflation is already here, guys. You just don't see it yet in the prices because they're not allowing you to see it in the prices to like the shadow stats will show you. But it's not just that, it's money velocity as well. And the money is pent up and it's ready to go. And they've talked about it many times that it's, the unusual tools that they are using, these, tools that have never been tried before. This is it. It's a big psychological game that they're trying to play right now. And you can really see it happening. The other article coming from, what was it? The American Institute of Economic Research, I think is the name of it. I guess I've read a few articles coming from this website, but anyway, I'm not terribly familiar with them. But the article I thought was quite interesting, and really they're going into that pent up demand of bank reserves, which is something to kind of think about in itself, is that, the banks are sitting on a lot of reserves that are sitting at the Federal Reserve Bank. Now, if the 10-year Treasury all of a sudden starts paying out a whole lot more than these Federal Reserve deposits, well, then banks might start feeling a little bit better about putting their money into the Treasuries than sitting it at the Federal Reserve. That could be where the demand for the Treasuries start to come in from. Okay, so a lot of people say, like, where is the United States going to be able to borrow from? Well, if the interest rates start to rise on it, then they'll be able to sell them to the banks instead of holding reserves. Or the banks could start finding people to lend it out to you. If you think about it, if you're in a hot economy and things are moving and the velocity is picking up, well, then you're starting to feel a little bit more comfortable about lending that money out. You might send those reserves out there into the economy. Well, with all that money out there and those bank reserves sitting at the Federal Reserve not really doing anything, now all of a sudden they're out in the economy chasing things around. Well, then you can start getting your inflation. I mean, there is a very plausible possibility of higher interest rates coming into our future. And I'm not the only one who's saying it. I mean, it's a very real possibility. So anyway, thank you guys for hanging out with me this evening. Uneducated Economist, you guys let me know.